Liz Young is the head of investment strategy at SoFi. She joins us live now from New York. Liz, thank you so much for being with us. Here's the thing, inflation fears are nothing new. The fact that the Fed is going to be raising interest rates, that's nothing new. But it's really this idea that now inflation is hurting corporate America, hurting profits. That's the key here.
That's one of the keys. I think actually the bigger key is that we're now getting confirmation that the consumer has slowed down a bit in spending. And that was the big positive that we came into this on. We were hanging our hat on the fact that the consumer was still spending a lot, still had a lot in savings. There was all this pent-up demand. The labor market was strong, so the consumer would stay strong. And now we're getting those first hints of maybe there's going to be a relaxation in spending. Maybe there's going to be a difference in patterns as we move through summer and things could cool off a little. But I would also suggest that that's what needs to happen in order to bring inflation down. So although unfortunately retail stocks are getting hit hard today, some of the movement and some of the data that came in is not necessarily the worst thing for the inflation picture.
So how mixed is the data? Because you're getting, in terms of retail stocks, certainly a bleak picture, but retail sales coming in, rising at about 1% in April. That showed a slightly more of a positive picture. So just walk us through the numbers here.
Yeah, so the retail sales number actually missed expectations very slightly, but it was still positive for April. If you look at, though, going into, now we're in May, we get into June. Once we get those May numbers, I think we're going to see a little bit of a relaxation in retail sales. Also, retail is a big category, so you'd have to lump things in there that are also luxury brands. Those don't necessarily get hit hardest, at least on the front end. The luxury consumer tends to react a little bit later in the cycle. So you're going to see some of the brands that are more sensitive to lower end spending get hit harder and get hit faster. The other thing I would say is that the consumer can react a lot more quickly than a business can react. If you think about a business and what goes into controlling costs and trying to protect the net income picture, it takes them a longer time to decide, okay, we need to pull back on spending, maybe we hire less. Those are longer quarterly decisions, whereas the consumer can decide on a Friday that they're not going to spend as much next week. So there's a timeline difference there too.
And Fed Chair Jerome Powell just said yesterday that, listen, if inflation isn't tamed, if it isn't contained, then the Fed will have to continue raising interest rates until it is. How is the market likely to respond to that in the short term?
Well, I think we were seeing some of the response today, and we've seen quite a few down days already this year, actually the most down days that we've seen at this point in the year since 2009. So the reaction to his comments, first of all, the comments were not really a surprise, and inflation is still very high, so they do need to control it. It doesn't change the expectation that we're going to see probably another 50 basis point hike in June, maybe another one in July, and that they need to see data that shows them that the peak in inflation is behind us. The challenge that markets have to get through now is that we're not going to have confirmation of that until probably closer to the third quarter or maybe into the third quarter. And we still have to deal with some uncertainty around midterm elections. So there's still a lot to trudge through here for markets. And I don't think that it's going to let up, unfortunately, as far as volatility goes for the next few weeks. We still have to get through a few more Fed hikes and maybe even into July when we're going to see volatility finally calm down a bit.
So chances of a recession at this point, and how does the U.S. stave off one?
Well, I don't think that we're going to see a recession in 2022. I think that the negative GDP print that we saw in the first quarter was due to some factors that are a little bit more short term. So I don't think we're going to see that recession, meaning 2 consecutive quarters of negative GDP growth. I don't think we'll see that this year. 2023 is a different story, but how does the U.S. stave off a recession? This is something that I think people always need to remember. You don't have to go into a recession in order to just cool down demand. So it is possible that demand can cool, the consumer can spend less, we can see earnings revisions downward a little bit without everything going into a complete contraction. So that's what the Fed is hoping for. That's what I'm hoping for the rest of the year and into 2023, that we just see a moderation in growth, a moderation in demand that brings us more into balance, but that we avoid a big recessionary scenario.
Yeah, that's a good point. Let's hope a lot of the fears that many have are indeed overblown. Liz, we have to leave it there. Thank you so much. Appreciate it.